Altseason is coming, but the rules have changed. This cycle is led by blockchains institutions can trust with billions. And the next wave of money is already deciding where to go. So let's break down Solana, XRP and Cardano through one brutal lens. Would the SEC approve it and would Wall Street buy it? Wall Street is in crypto now, whether you like it or not, and big money moves in order. They start with what's proven, Bitcoin, then Ethereum, and once that's filled, they move down the curve into other altcoins looking for the next opportunity and yield. We saw the same pattern with gold ETFs, when money moved from metal to miners. They bet on safety first, then chased yield, and that rotation has already started in crypto. But before we get into the chains, here's what the SEC and the institutions following its lead are actually looking for in a crypto ETF. It's 7 metrics. They want secure custody, transparency and surveillance, liquidity, full disclosure, transparent pricing, and legal clarity. That's the playbook every ETF must pass, fast-tracked or not. And now let's see which blockchains are your best bet. Solana is emerging as the star of this institutional altcoin push, and we already saw the first US spot Solana ETF being approved, and major issuers like Grayscale, VanEck, Bitwise and others all lined up Solana ETF filings this year. So just to put this into perspective, we already saw huge money flows into Solana products even before the first ETF approval. Globally, Solana ETPs have exploded to over $5 billion in assets. So investors are already positioning heavily into Solana via existing vehicles. And I mean, why wouldn't they? Solana is fast, liquid, and it already looks like the high beta play you use when you want returns. It's built for velocity, traders love it, and volume moves easily across the network. That's exactly what short-term allocators want when they're chasing performance. But also keep in mind that it's a trader's chain, heavy on meme coins and pump and dump schemes. So it's not quite the blockchain for a pension fund just yet. Solana also still carries some baggage from its past with multiple network outages over the years, the last one being in February 2024. And yes, absolutely, reliability has improved and they have hit that major milestone, but risk desks have long memories and I think we need to give it a little more time just to make sure, because for long-term institutions, the one managing pensions, endowments and sovereign funds, those old outages are enough to keep Solana labeled as a momentum trade and not quite yet a core holding unless they turn it around. But right now, Solana still offers a compelling mix. Scalability with more upgrades on the way, improving reliability, and a growing network. It's exactly the kind of asset that fits the ETF mold. But whether those inflows will stick depends entirely on one thing. Can Solana prove its ecosystem is truly mature and built for uptime? Otherwise, that capital will likely behave like momentum money and stay high risk and high reward. Cardano is also stepping into the institutional spotlight. It's often dubbed as the slow and steady blockchain. No meme mania, no VC puppeteering. Cardano is focused on real organic growth and a solid foundation. It offers strong principles, peer-reviewed code, high reliability, and a governance model that is built for regulators. And it already shows. Cardano just scored a major win via a multi-asset ETF, where Cardano is one of the 5 cryptos included in Grayscale's digital large-cap fund, alongside Bitcoin, Ethereum, XRP, and Solana. And a standalone Cardano ETF is also officially on the SEC desk, and the market is optimistic, with approval odds at 90%. So why exactly are institutions increasingly interested in Cardano? Beyond the ETF momentum, Cardano's fundamentals have quietly been improving, and the ecosystem is steadily growing in terms of DeFi, RWA, synthetics, and a bridgeless Bitcoin integration is also on the horizon, effectively turning Cardano into a DeFi layer for Bitcoin without having to wrap coins. And no other blockchain does it like Cardano, and that's pretty extraordinary. So from an institutional investment angle, Cardano is checking many boxes. It's often been seen as the methodical, high-potential later payoff project, and now that payoff could be near. And here's where I think Cardano truly stands out for institutions. It is one of the most decentralized blockchains out there, with thousands of stake pools validating the network, and in over 8 years of operation, the network has never seen a hack. It never suffered a chain hold and has maintained 100% uptime, which is something no other major layer 1 can claim. And for institutions and regulators, that kind of operational resilience and security matters more than hype. It shows predictability and engineering discipline, which is exactly what long-term allocators would be looking for when they're trusting billions. So that's why I personally think Cardano wins the stickiness. Less liquidity today, but the most policy-ready architecture for tomorrow. And as Cardano's team likes to do it, it's happening gradually and then suddenly. So I think the inflows will come later, slower and smaller, but I think they will stay longer. Because once compliance funds rotate out of the hype and into structure, Cardano will be one of the cleanest chains left on the board. XRP is the digital asset that is best known for powering Ripple's payment network. And it's one of the oldest cryptos that is still ranking in the top 10. Now, unlike most of its peers, it's already been tested in court and officially declared not a security in itself. And that clarity gave institutions what they value most: regulatory certainty. And it shows. XRP already sits inside the Grayscale Digital Large Cap Spot ETF alongside ADA. And several issuers, including Grayscale, 21 Shares, Bitwise, and others have filed for standalone XRP ETFs. Now, the government shutdown has stalled the approval progress, but things are looking extremely optimistic, with approval odds at 99% and a decision likely being reached by the end of this year, if everything goes well, of course. So why are institutions gravitating towards XRP? Well, because it uniquely blends that regulatory green light with a real-world use case in finance. Ripple uses XRP to settle cross-border payments, which has been growing quarter over quarter. The real utility makes XRP somewhat unique among altcoins in the eyes of institutions. It's not just another DeFi platform or Ethereum killer. Investors see XRP as a play on payments utility rather than a crypto market beta. XRP represents a kind of institutional-grade altcoin. It has a defined use case, fast and low-cost international transfers, it offers deep liquidity, operational resilience, and it has maintained near-perfect reliability for more than a decade. So it's not a surprise that big players see long-term value proposition here. So my personal takeaway, XRP isn't the beta trade, it's the payment infrastructure trade. Big ETF inflows here will likely come from bank-linked funds and payment sector investors. And yes, they're somewhat slower to move, but they have much deeper pockets once integration ramps up. So XRP's capital will behave more like strategic positioning instead of chasing hype. It will accumulate as its network partners expand. So think of it as the adoption trade, less explosive and much more purposeful with capital that grows. So to wrap this up, if you map the likely flow of capital, it will probably go from BTC to Ethereum, then Solana, XRP, and ADA. Solana will likely move the fastest and get the most liquidity short term. XRP will follow and grow alongside traditional finance adoption. And Cardano might build the stickiest base. ETFs opened the door for institutional money, and yes, there are even more cryptocurrencies with ETF decisions pending, like Chainlink, Polkadot, Avalanche, and even Dogecoin. And once regulation fully settles, there's nothing left to wait for. That's when I think the real Altseason will begin. But no. It won't be the Altseason you know. I don't think we'll see many 100x opportunities pop up anymore. Crypto is now being engineered in the boardrooms, whether you like it or not. The ecosystem is maturing, and maybe in the long term that's a good thing. I'm not sure. All I know is that I truly miss the good old days. Thank you so much for tuning into this video, and as always, combine this insight with your own due diligence. Keep being awesome. Bye.